Hello everyone, welcome to today's US Open live webinar. It is Tuesday, October 10th. I'm your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. Of course, the renewed violence that erupted in the Middle East over the weekend is what dominates the news after the deadly attack of Hamas on Israel and the country's retaliation. So we will be talking about that and its implications for the oil market and the stock markets as well. Wall Street tries to look past this risk of situation already with the help of some dovish, we would say, commentary from the Fed. We also have key upcoming events from the United States, including mainly the US CPI inflation update. We also have the new earnings season getting underway. And we also have the initial public offering of German footwear maker Birkenstock, which is expected potentially as early as Wednesday, but there's no set date yet. So that is what we will be talking about today in another packed session. But before we begin, as always, please read through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give it a few more seconds and then we will go ahead. Okay, let's get the ball rolling because we have quite a few things to cover. We're gonna start today with EURUSD as always. Then we're gonna move to USOIL and how it's being affected by the events in the Middle East. Then we're gonna talk about the SPX 500, the US broader index. And then we're going to cover the upcoming events, mostly the US CPI inflation update. And we're going to talk about the new earnings season, which kicks off with Delta Airlines and big banks towards the end of the week. And we're also going to talk about the upcoming initial public offering of the iconic footwear maker Birkenstock. So let's go right ahead with EURUSD, which we already see on our screen, and which manages to react from its 2023 lows at the start of the month. As the greenback loses steam, shows some exhaustion, and the latest Fed commentary works in the pair's favor, because we saw some conservative talk about around more hikes, the prospects for more hikes, despite the hot labor market report from Friday. Now, the common currency tries to take out the critical confluence of resistance is at roughly 1.064, 1.067, which includes the 23.6% Fibonacci of the of the last drop. You can see this drop right here from July from July highs to the October lows. Successful effort can accelerate the recovery towards the 38.2% FIBO and the 200 days EMA, the blue line that you see on your chart at around 1.0763. However, we struggle to see meaningful progress for the euro in the current environment. The ECB has hinted to peak rates, and recent commentary supports such outcome, while the Fed has kept the door open to more hikes amidst tight labor market, still high inflation, and strong economy. Bias is clearly on the downside, and the death cross, you remember we talked about it last week extensively and in previous session as well. This is the death cross on the daily chart, where the 200 days EMA, actually the 50 days exponential moving average crossed below the 201. This is a technical death cross and is often a precursor of sustained weakness. So bias, as we said, is on the downside, and we can and there's definitely risk for further losses towards 1.0337, although bears may need fresh impetus in order to tackle that level. Now let's turn to US oil. Energy commodities benefited from the deadly attacks of Hamas on Israel, as the region is a key oil and gas hub. The events unfold as supplies tight and inventories diminish due to the OPEC Plus massive cuts. On the other hand, there are concerns around demand due to China's weakened recovery and other factors. Iran's involvement in the attacks is also critical for the oil market, regardless of whether it did back them and to what extent. It now looks hard for a rapprochement with the West that would lift sanctions on Iranian oil, and which would help the market lose up. US oil comes from a 4-month profitable streak that culminated in the recent 2023 high. However, it was contained ahead of the descending trend line for the March multi-year highs and subsequently slumped below the 200-period exponential moving average. This creates risk for further declines towards 77.57, but sustained weakness does not look easy, and you can also see how the ascending daily Ichimoku cloud, this blue cloud, can provide renewed support. The Hamas-Israel skirmish boosted oil prices on Monday, and US oil price to return above the 200-period DMA that will allow it to pursue higher highs, but we are cautious around its ability to tackle the $100 mark, which was talked a lot about recently, and definitely before we see this last pullback. We're cautious around prospects of prices above 100. Okay, now let's talk about the SP 500, which looks past Middle East and Friday's hot jobs report, held by the conservative commentary from Fed officials this week, such as Ms. Jefferson and Ms. Logan, who worried over the rise in yields, refrained from talking for more hikes, even though they generally reiterated the need for sustained, prolonged restrictive stance. SPX 500 tries to retake the 200-period DMA, and with that, the initiative, successful effort will allow it to look towards the 4,450, 470 region, where the daily Ichimoku cloud and the descending trend line from the 2023 highs converge, but we're cautious for its ability to actually tackle that level at this stage. The index comes from 2 straight losing months, and as long as it does not clear the 200-period EMA, immediate bias is on the downside. Middle East headwinds can persist, and the Fed may need to hike again given elevated inflation, as we said, hot labor market and strong economy, what we said before as well. And the IMF, for example, they upgraded its GDP projection significantly for the US for this year and the next. There is as such there is risk for renewed pressure back towards 4,204, 4,171 region, although a catalyst would be required for that. The trajectory of the index will be determined by key upcoming releases and, of course, the quarterly results from Wall Street, which get underway. Having said that, let's see what we have ahead in terms of releases. It is a busy week with key events and a slew of Fed speakers and from other central banks as well. We have the Fed minis on Wednesday. The central bank had delivered a hawkish hold in September since it maintained the median terminal rate projection that implies another hike and increased its 2024 expectations to 5.1%, showing a more aggressive path for the next year, or a less dovish, we could say. Now on Thursday we have the US, and before our next session, we have the September CPI inflation from the United States again. Inflation has moderated substantially, and the sticky core decelerated further in August to 4.3% year over year, in the small increase in nearly 2 years. Headline, however, rose for second straight month to 3.7% due to higher energy prices, and the events in the Middle East can exacerbate those upward pressures. Now, I want to talk about the new earnings season. Delta Airlines reports on Thursday, and we see its chart on our screen. It is coming off a strong summer period for air travel, but carriers face increased fuel costs due to the rise in energy prices over the past few months, and the situation could worsen, let's say. Prices could increase further due to the Hamas-Israel war, and Delta Airlines has already cut its profit outlook significantly due to rising fuel costs. Delta dropped yesterday due to the events in the Middle East, but opened higher just now with 4 minutes into US session. And we will be looking forward to its quarterly report on Thursday. Big banks like JP Morgan pick up the baton on Friday, with the sector running the third straight losing months, as depicted in FXCM's US banks basket, which includes JP Morgan and other big lenders. And JP Morgan, you can see that it's having a lackluster month after 2 straight losing ones. Despite higher interest rates, which generally are helpful for banks, the inverted yield curve poses a headwind, which has been inverting for a very long time. So again, that is how the new earnings season begins, with Delta and big banks like JP Morgan, which comes on Friday. And I want to round things off with the expected initial public offering of the iconic German footwear maker Birkenstock, which is known for its sandals. The company is due to go public in New York in the latest high-profile IPO, following the recent listing of ARM, Instagram, and others. There is no exact date and pricing yet, but we will likely have details very soon, as the debut could be as early as Wednesday. So we'll be looking to see the exact price and date. What we know so far is that the IPO is set at the price range of $44 to $49 per share, which can lead to a valuation close to 10 billion. This development for Birkenstock comes not long after its sandals were worn by superstar Margot Robbie in the blockbuster Barbie movie, which was released in July and quickly became the highest grossing film of the year in the global box office. Now, Birkenstock's revenues in terms of financials increased in the first 9 months of the year significantly, but profits narrowed. The firm plans to extend its lineup and increase output over the next 5 years, and all these things are good for a company that is about to go public, but not the profits, of course, but the revenues and the expansion in the lineup. However, the environment is challenging for discretionary goods, and the recent IPOs like that of ARM we talked about have shown that investors are weary of lofty valuations. So again, we will probably have more news around Birkenstock imminently. That's pretty much it from us for today. Thank you for joining me. We will talk again on Thursday at our usual time, 10 minutes before Wall Street opens.